Hi, Paige Deers. I'm here with Greg Austin. We're talking about Houston multifamily investment, a hot market right now. So, Greg, tell us, do you think this demand will continue to outpace supply, and for how long?
Well, Paige, right now we are undersupplied on the apartments overall in the city, and we think as long as we have the population growth and job growth that we have in the market, which was first in the nation in 2012, we think that we're in a very good position to have the demand continue to outpace the supply.
So, if you've got a lot of demand, does that mean that investors are looking to secondary or tertiary markets? Have the cap rates gone so low that they really are going a little bit broader?
Sure, most definitely. What we're seeing is very compressed yields in the core and core plus submarkets. So we're starting to see even institutions go outside those markets and get out into the suburbs.
That's new, right, Greg?
That's really come in probably the last half of 2012. But the difference in cap rates out there are probably 100 to 150 basis points. And I think we're going to continue to see that because replacement costs out in the suburbs are going up with construction costs. So you can now buy an existing property and at probably a 10 to 15,000 unit discount to replacement cost.
Well, that sounds like a good buy, so I'm sure people want to do that. Let's also talk about other ways that people are placing their capital into multifamily real estate. You talked about FHA being a player and a solution here today.
Right. FHA has programs 221D4 and 223F that are 35 to 40-year self-amortizing loans. So we're seeing institutional buyers, hedge funds with real estate arms that are going out and closing into that debt where they know that there's some potential for hyperinflation over the next 4 to 6 years, and they can basically combat that by locking into these 35 and 40-year term loans.
So there's no shortage of opportunities here in Houston for multifamily. Thanks for educating us today, Greg.
Thanks very much, Paige.